Hi everyone. Most dividend investors own the wrong fund and don't even know it. 4 ETFs dominate retirement portfolios: SCHD, VYM, DGRO, and VIG. Same promise, passive income forever, different results. One turned $50,000 into $98,000, while another barely hit $82,000. Same decade, same risk, $16,000 gap. The second fund I reveal pays 3.6% today while compounding your income 40% faster than competitors. I'll show you which ETF wins, which ones fail you, and the exact allocation based on where you are in life. Remember, this is educational content, not financial advice. Always do your own research before investing. Financial advisors often say buy any dividend ETF. They're all basically the same. That is misleading. These funds use opposite strategies. One maximizes today's cash flow but stagnates your future. Another pays almost nothing now while promising growth later. The third attempts balancing both and achieves neither. Only one delivers high yield today and rapid income growth while filtering for quality. Choose poorly and you leave serious money on the table. 4 funds, 4 philosophies. Let's break them down. VYM, Vanguard High Dividend Yield. The Income Now approach holds 600 stocks paying the highest current yields. The dividend is 2.4%. It seems reasonable until you examine the growth rate of 3.79% annually over 5 years. Barely outpaces inflation. You collect checks today while inflation slowly erodes your purchasing power. 10 years from now, that same dollar amount buys you significantly less. VYM works for one specific scenario. You need maximum cash flow immediately, and your time horizon is short. Everyone else faces a purchasing power problem long term. VIG, Vanguard Dividend Appreciation. The opposite approach. Demands companies raise dividends for 10 plus consecutive years. Sounds prudent. The cost? A modest 1.6% yield. You're earning less than many money market accounts, but the dividend grows over time. True, eventually. Meanwhile, you're sacrificing current income waiting for those increases to compound into meaningful amounts. If you need substantial income within a decade, VIG creates a cash flow gap in your early retirement years. DGRO, iShares Core Dividend Growth. The balanced approach. Targets dividend growers without VIG's strict requirements. The yield is 2.04%. Dividend growth 9.2% annually. Appears optimal on paper. The hidden limitation? Extreme diversification. Top holding, JP Morgan. Represents just 2.99% of assets. When value stocks surge, DGRO captures a fraction of potential gains. When growth rallies, DGRO trails behind. You own a fund so evenly balanced, it rarely dominates in any market environment. Consistent, but never exceptional. SCHD, Schwab US Dividend Equity. The fund that solves the income versus growth dilemma. It doesn't sacrifice today for tomorrow or tomorrow for today. It delivers both through systematic quality screening. The methodology? Only companies paying dividends for 10 plus consecutive years qualify. That eliminates inconsistent performers. Then SCHD ranks survivors on 4 fundamental metrics: cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. The top 100 companies make the cut. Underperformers get removed annually during rebalancing. The outcome? 3.6% current yield, substantially higher than DGRO and VIG. Plus 10.6% annual dividend growth over 5 years, outpacing all 3 competitors. You collect more cash today, and your income compounds faster over time. Real money comparison. Invest $50,000 in each fund, hold for 10 years, reinvest all dividends automatically. VYM with 2.4% yield and modest growth grows to approximately $82,000. DGRO with balanced performance reaches approximately $88,000. VIG with lower yield but solid growth. It hits approximately $90,000. SCHD climbs to approximately $98,000. Identical starting capital, same time period, same market conditions, up to $16,000 difference between best and worst outcomes. Scale this up, invest $100,000 instead of $50,000. That gap doubles to $32,000. The fund you choose matters significantly. Or scale it differently. Invest $10,000 and add $500 monthly. Over 20 years with SCHD's historical performance, you'd accumulate over $430,000 with annual dividend income exceeding $15,000. The same contributions in VYM would generate meaningfully less income growth over that time frame. Why SCHD performs well during sector rotations. When technology struggles and value sectors strengthen, SCHD's sector composition provides stability. Energy represents roughly 14% of holdings, financials roughly 17%, consumer staples around 16%, healthcare approximately 15%, industrials about 14%. When growth stocks decline, SCHD maintains steadier performance. VYM dilutes this sector advantage across 600 total holdings. DGRO and VIG maintain heavier exposure to growth-oriented sectors that underperform during value rotations. The limitation you must understand, SCHD avoids heavy technology exposure. When artificial intelligence and growth stocks rally powerfully, SCHD will likely underperform tech-heavy funds. That's the deliberate trade-off. You receive stability, income, and quality screening, but you forego participation in explosive technology-driven rallies. SCHD functions as portfolio ballast, not your entire portfolio. It prevents severe downside when markets struggle while still providing respectable upside during broader rallies. Your allocation strategy based on life stage. Already retired needing immediate income? Consider 70% SCHD, 30% VYM. This stacks higher current yields. SCHD grows the income over time, while VYM boosts immediate cash flow. Building wealth over the next 10 to 20 years before retirement? Consider 100% SCHD among dividend ETFs. Superior yield combined with superior growth. Less reason to accept DGRO's moderate performance or VIG's lower current income. Under 40 with decades of investing ahead. Consider 50% SCHD, 50% growth-oriented ETFs such as VOO or VGT. SCHD provides portfolio stability and income. Growth exposure captures upside during bull markets. Strong markets reward you. Weak markets don't devastate you. This balance works across different market environments. What trips up many investors? They assume all dividend ETFs function identically. They select VYM because Vanguard feels trustworthy. They choose DGRO because dividend growth sounds intelligent. They rarely compare actual performance data across funds. SCHD has outperformed VYM over extended periods. It's beaten DGRO consistently. It matches VIG's total return while distributing significantly higher current income. The historical data favors SCHD for investors wanting both income today and income growth tomorrow. Important tax consideration. In taxable brokerage accounts, qualified dividends from all 4 ETFs receive favorable tax treatment compared to ordinary income. However, SCHD's lower turnover ratio compared to actively managed funds means fewer taxable capital gains distributions. If you're investing in a tax-deferred account like an IRA or 401k, this tax efficiency difference becomes irrelevant since you're not paying annual taxes on dividends or capital gains anyway. The popularity consideration? SCHD assets under management reach $83 billion, making it one of the largest dividend-focused ETFs. High popularity creates considerations. Price appreciation can lower the yield available to new investors entering positions. Additionally, widely held positions sometimes experience sharper selling during market panics as many investors exit simultaneously. Protection approach. Dollar cost average into SCHD rather than investing your entire allocation at once. Spread purchases across 3 to 6 months. Market pullbacks become opportunities to acquire additional shares at temporarily lower prices. This reduces the risk of buying your full position right before a correction. The comparison conclusion? VYM emphasizes current income while sacrificing future growth. VIG prioritizes growth while minimizing current income. DGRO attempts balancing both and achieves moderate results in each category. SCHD delivers strong current income, strong dividend growth, and systematic quality screening. If dividend investing forms part of your strategy, SCHD deserves consideration as a core holding. Pair it appropriately based on your age and income needs. Rebalance your allocation annually. Reinvest dividends for maximum compounding. Let time and consistency build wealth. I analyze dividend ETFs regularly so you can make informed decisions. Want to discover which individual dividend stocks might outperform these ETFs? Watch that video next. Tax notes. All provide qualified dividend treatment in taxable accounts. SCHD offers lower turnover advantage. Disclaimer. Educational analysis only, not financial advice. Consult professionals for personalized guidance. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.